Hello guys, glad to have you on board again today. Looks like you wanted an update, even though I personally think that the technical uncertainty is pretty damn visible to me. And the psychological mismanagements are as well, but looks like you still need a refresher, so we're gonna do it, okay? So I assume that most of you guys should be able to do this on your own if you've learned my strategy, because these are really the standard first rules that I generally teach you guys. So normally most of you should be able to navigate the current market conditions, though the problem is more or less in the psychological management. Okay, so it means that even though you have the rules to process the market correctly, you might still suffer hell a lot of mental pressure, and therefore it's only a matter of time before you make mistakes. So in that perspective, well, no shit Sherlock, that's how you progress in trading. You learn technical rules that will help you shift your mismanagements, the things that you would have fell for back then that you won't be doing today, because you have a set of rules that will confidently soothe your mental pressure without deleting them. Like I've always made it clear, I do feel the pain as well, just like you do. It's normal. We are human beings, so if you feel like you're ever going to turn out as a robot because every trader feels like emotionless people or whatever, this is just, I mean, general fantasy. It's not the case. If you really meet with true traders, we're just normal human beings. We're not psychopaths without emotions. We just have learned through time to absolutely destroy emotional response to stimuli. And most importantly, when it is coming along with trading, which means we put a distance between things and us. That doesn't mean that things do not touch us. That just means that we never act upon the things that touch us. Okay? And particularly with trading. So I've made an entire set of course on YouTube about it, how it's actually due to brain plasticity and all of these things that you're going to slowly deteriorate your terminalis. So look at all these things that I've put it out into YouTube, so you'll eventually get a better understanding of what truly is at play when you change yourself into a more trader compatible type of behavior. But these sets of rules that I teach you, you still already know them. It's just that it's harder to apply when the mental pressure gets heavier. So I'll explain everything about it today, okay? Aside from this, I also wanted to tell you that I'm going to have to put out another video that will delay yet another set of the trading lessons update. But yesterday have been, I don't know if it was 2 days ago, but I took my profits on most of my metal trades and lots of other commodities. So it has gone way faster than I expected. This was one of my major plans for 2022. So I'm questioning whether or not I should review this, but anyway, we need to update on that plan. Look at the long-term charts, what's level have been touched. Is it really due to the war catalyst, or is it just that I need to readjust the long-term targets? So we're going to answer those questions in a much more commodity-oriented video that I'm going to have to pull out by next week. Okay, until then, let's stick to the current plan, cryptocurrencies, okay, and all of these things, and why you guys feel the pain now. So using the same old set of rules, okay, a strategy is good only if you don't change the rules in the meantime, otherwise this is no strategy. Okay, so what does my strategy tell me? It tells me that if you know how to navigate the rules that I give you, mostly figuring out which time frames do risk manage and which time frames are absolutely crappy stuff that you shouldn't even pay attention to. This is one of the general mistakes that you do when you learn my strategy. So of course, as usual, when I see some weakening decisions or issues, I try to pull out kind of a tool that will help you do things more efficiently. So you had troubles figuring out which time frames should be suitably looked at and which ones doesn't matter. Well, in that perspective, I gave you a multi-time frame vision of the markets in which you don't have to scroll through multiple time frames. You'll immediately be able to figure out where to look at, where not to, and you're going to be able to build up hypothesis right out of these things, which means, yes, another video is required as well to teach you how to do these things. So don't worry, this is on the plans. Too many things to navigate now, and the markets comes first, okay? Life comes first, then comes the markets, and finally comes the educational content. So I'm sorry guys, I wish I could do everything all at once, but I have a limited 24 hours a day, and I also need to sleep. So understand that right now my current priorities are to handle life and still do the normal stuff and pay attention to my loved ones. But in that perspective, I also need to trade, which means I have a very limited amount of time for education. But don't worry, things will soothe, and as they will calm down, I'll have more available time for educational stuff. Okay. So without going into the details of the dashboard, the core essential you need to figure out is that this is basically the position of the context, which remember the context is our value perspective of the market. This is where prices are expensive, this is where prices are cheap, and this is the average median kind of value. So this is the value channel, okay? And we assess and we study how prices do react to those value. Okay, and we also study the historical values through standard moving averages. Okay, so this blue coloring in here tells me that the moving average is below or inside the support context, at least inside or below. Okay, so that tells me really one thing. Okay, though in that perspective is not really that complicated. I hope you guys do understand what this is what this is all about. Okay, so really not that complicated. Though weekly chart means the prices, the value is rising faster than the average value. So prices are accelerating to the upside one way or the other. Okay, whether that is a trend or not is still to be seen, but that means that prices are pushing up or value is pushing up. Okay, this is price territory. So this is value, this is price. And as always with my strategy, we're assessing the dynamics between the two. Okay, so we're going to study the value movements across different time frames because there are longer time frames and short-term ones, and they will sometime opposite one to another, meaning that a range is going on. When you have bullish pressures on one time frame and bearish pressures on the lower one, means one of them is lying, okay? And therefore that means the range, a battle between the bull and the bear will of course occur, okay? So you look at this first because this is where you're going to see asymmetries or anomalies, call them however the fuck you want. Okay, it's really that simple. We're bullish on the weekly chart time frame, neutral daily, and bearish 4 hours. So among these 3 time frames, there's definitely an opposition, right? One of these is going to be wrong. God knows which one. We're going to have to figure it out. But that means a range is going on in this time frame. The range is, of course, right now pulling itself into the daily chart. Okay, meaning that the weekly is still very much favorable to the bulls. And right now the bears are in control for the 4 hour. Okay, so there is a battle in between these two. We're going to try figuring out. That means battle means uncertainty. Some camps are fighting each other. The bears are fighting the bulls. Who's going to win is the question we need to answer. In a normal market, when bulls are fighting bears, well, there's an equal chance to succeed. This is 50-50 gamble. But when trends are at play, this is no 50-50 game. Trends always shift probabilities one way rather than the other. It's no 50-50 game when there is a trend. Otherwise, we would see ranges everywhere, and we do see trends. So when the market is trending, it's no such a thing as 50-50. You always follow the trend. It's easy as that. And if you don't want to like that statement, you need to stop trading right now, okay? Sure thing, they are ranges most of the time because bulls are fighting bears. But when one camp has brought along the other, or sold it out, in that perspective, this camp has control of prices for a limited amount of time because, of course, trends do not last forever. This is why I teach you trend maturities and all of these things. Really important stuff. We just don't blindly buy trends. But this one, without going further into details of how mature, has a lot of maturity to go. We're still far off the maturity of these weekly trends. So until further notice, we need to follow them. So the bulls will win. End of the game. We don't need to go any way further than that. We've made our study. Anyhow and anyway, the bulls will win. Prices will be more expensive weeks from now. This is not a certainty. This is just statistical behavior. There is like 80 to 20% chance. So in my personal belief, that will be even more than that because we have multi-time frame trends. But let's call it neutral, okay? 80 to 20% chance to have higher prices, let's say a year from now. And I'm pretty damn confident to say it. And I don't think that's any such a thing as the opposite direction being likely. I'm saying it's 20% chance. So if you want to gamble on 20% chances of something to occur, well, good luck with that. That means, well, you better get some 50-50 gambles. You will have higher chances to succeed. Though I very likely would like to be on the opposite side of it, meaning that if I have something that's giving me 80% chance to be true, well, I'm definitely going to bet on it. That doesn't mean there is no such a thing as a risk management. It's all a matter of how much am I willing to put in, at which price, to get this 80% chance of having a higher price. Because of course, if I have to put 80% of my money to gain 20%, well, that's going to be a problem, because if I end up being proven wrong, I'm going to lose 80% of my money. So it is really not how risk limitation comes in. But you have to understand these different rules, okay? The bulls will win. That doesn't mean they have 100% chance to win. It's just that they have far more than 50% chances to win. And I hope you do make that difference. Okay. The daily chart is very likely going to be neutral, so let's have a look at this to figure it out. Oh, daily chart is neutral. Yeah, we got a range. We can see the moving average is inside, but the moving average is rising. So this range is no neutral. This is a bullish range. So the bulls still have controls of historical prices. They've lost control of value, which means the value is neutral, but the historical prices still push to the upside. So daily is not neutral. It's neutral bullish. The bulls have a slight advantage over the others. But the range is mature anyway. We've got 1, 2, 3 sets of waves. We always pay attention to the third range boundary, because this is where the risk limitation occurs. We had a bearish third range boundary, which has been validated and broken, to turn it out to a neutral third range boundary with very limited bearish signals. So the bears definitely don't control in this range. And we have the assessments of it, okay? Then we've got to a fourth range boundary, so the range is now mature. We do not trade in this range anymore, but we only use this strategy, which is, if we want to trade, we're going to go dumb trading, meaning that we put Fibonacci's, and there's no such a thing as trading aside from these things. Which means anytime we get into the blue area and we are below the context, we buy, eyes closed. So there was a nice buy entry here. Of course, this comes with a large fucking stop loss, meaning that we do not take too much risk because the market is neutral. Though, in order to make $1 gain, we're willing to risk $1 of losses, okay? But as we've seen, this range has higher pretension to the upside. So it's not 50-50 here, because the bulls have a slight advantage. It's definitely not 80-20. In here, we're more like 60-40. But 60-40 with a 1-to-1 risk-reward ratio is still something I will blindly bet on anytime it's put it in front of me. That doesn't mean it will work out on this thing. That just means 60 to 40% chance with a 1-to-1 ratio is fucking profitable. And there's no way around it. If you do not agree with that, stop trading. Go gambling, go whatever it is, lottery. No way you can lose money out of this thing. That doesn't mean this one will work. It just means out of 100 trades, you'll make money. Okay? That's what strategy is all about. Substrifying one trade to put it out of the context of 100 similar trades. Nothing is ever the same, so if you look at copy-paste patterns, bullshit. Noobs only are doing this. Professionals take an abstraction vision of the market to figure out patterns of behaviors in the market, and when they repeat, we repeat as well, as long as we have viable statistical outcomes, meaning that it's a matter of risk-reward ratios and probabilities of success. If both can meet a positive risk outcome, we take the trade. If it's not, then we do not. It's really that simple. Okay, so that's what my strategy tells me. Bulls have a little bit more control of this range, but this is where we need to trade it by a large stop loss as well, and we risk as much as we are willing to take, okay? And of course, when these things occur, we target a first taking profit in the mid area of the range and the second taking profit on the upper area of the range, or the opposite context. It's really that simple, and we're going to risk pretty much as we're willing to get. But we're very likely going to get hit by the target rather than the risk. It's really what it is. Higher chances to succeed, but not that very fancy type of risk limitation. Okay, though daily is not very interesting at the moment. Weekly, in terms of risk limitation and context, well, very much more interesting. The moving average is far below the support context, meaning that the value is rising faster than historical prices. No shit, Sherlock, this can be no difference but a trend. These trends have maturity. We need to figure out the preceding range and the breakout. Here it is. Okay, so as we keep on going with this one, this can only be but a trend. Okay, so it's been preceded by a range, the breakout is in here, and therefore we trend follow as long as we do not finish a bearish cycle with a mature range, which would be the pullback. So we're still very far away from pullback. That doesn't mean it may not occur, it just means it could, but right now it's not likely. So, well, we have a weekly trend, and this one is ongoing, meaning that the shifts in terms of probability is at least 80 to 20, just like we said before. So we've got our story. You can convince yourself that you're going to have to sell the 4-hour charts, and well, you can definitely agree on that. If you really are looking for reasons to sell, well, this is where the sellers might be in control, because in here, value is decreasing faster than the average prices, so there's definitely some bearish pressures out there. And in terms of sentiment, well, this thing definitely is oscillating. Look at the cycles, bull, bear, bull, bear. So we're kind of building a range inside a consolidation. So this is no more than a shorter time frame range inside a bigger range, which is inside a bigger trend. So if you're really convincing yourself that you need to trade on the 4-hour reference charts, you're going to have a lot of trouble, because my strategy clearly tells you that you can't. You will never be able to trade a shorter time frame range inside a bigger one. So daily chart is the range, and it's mature. So never the fuck you're going to be able to trade 4-hour charts references. So if you, right now you're looking at this chart, and I know you do, and you try to convince yourself that this thing is either bullish or bearish, well, of course you're going to figure out that it's bearish, because there are far more bearish tainted kind of statistic behavior in here. The bears look like they're in control of these prices, but they still traded in bottom area of a daily range, which is in the bottom area of a daily trend of a weekly trend follow. So statistical outcome of this range is definitely not 50-50. Definitely not. It's far more profitable for the bulls to buy this range than it will be for the bears in terms of statistical outcome, because the bears have limited downside potential, where the bulls will be able to take on much more gains further down the road. But remember what we said. Risk limitation and trading comes out of a combination of these two, meaning that it depends on the risk-reward ratios that you're willing to trade on. If you want to take long gains, then of course it's really to the upside that the potential is, but you're going to have to take high risks as well, though large stop losses. So the only mistake not to make right now is to buy these supports, because they definitely have statistical advantage of outcomes, but the risk limitation that comes along with it requires a weekly risk limitation. So very large stop losses below the breakout levels, a lot of patience, but they also require that you're going to keep those trades open for way longer than just a couple of weeks. And this is what I see people not being able to handle right now. This absolutely unmatched thing in which you take short-term risk limitation inside bigger time frames, probabilities or whatever. You're just mixing everything up. 4-hour chart right now can't be traded, because the daily chart is the reference range. This range is mature, which means if you want to trade it, this is the fucking dumb trading activity that you have, meaning that you go to the daily chart, and anytime the prices slip below the context and inside or below that blue area, you buy the crap out of it with a large stop loss, and you just let it behave as long as necessary. So yes, the 4-hour chart is bearish, and it looks bearish, and it definitely is. Because if you want to study deeper in terms of perspective, I would definitely understand what you guys fear or don't understand or being shifted away. So let's try to dive into the 4-hour chart. Even though I clearly stated you should never ever trade out there, let's look at why it is very psychologically impactful. Well, this level is no random price. Okay, this level is the levels in which we validated the trend. Remember, we broke the trend in here, and this is where we've reached validation and confirmation. So this is definitely a major step of the weekly trend. Look at the way we've been trading with this thing. We've, of course, confirmed the trend, which means we've pulled prices above. So this is the confirmation that the weekly trend is at play. We've gone back to this level where I personally have bought, eyes closed, and then came this very weird accumulation pattern. Like I said, if I've seen the distribution, I would have figured out the accumulation, but I wasn't. So no big deal. I just took my patience and waited out there for the structure to terminate. We've recovered the level, holding it as support, and made new all-time highs. Failed, pulled back again. I bought once again the same level, eyes closed. And of course, we dive below it again. Is it yet another Wyckoff pattern? Definitely not. This time we're just oscillating across the level on equal weighting strength. We have deteriorated volatility, meaning that the amplitude of the movements are getting shrinker by the day. And of course, we go above and beyond this level in a very, very hesitant kind of a sentiment. Meaning that what we have now is a negligent sentiment. We're in the bottom area of the daily range. So this is definitely normal to have bearish pressure and bearish sentiment and bearish all across the board kind of news flow. Don't expect bullish news to happen in the bottom of a range. It's not how it works. When we'll get the bullish news, the sentiment will be upward and the prices will be on the bottom, will be on the top area of the range. So understand it that way. Sentiment is confirming everything. The technical area is very psychological because that's hell of a big level that we're oscillating across. So we're bullish above, bearish below. And guys, you are getting yourself convinced that we're going to break when we're in the upper area. And this is exactly where the pros are taking profits. Those who arbitrage that range in the short term are buying and taking profits in here. They're buying again and taking profit in here again. So right now we can go into the buy area again, and guess what? They will probably buy one more time. But the thing is that as long as we do not break this level, we're locked into this range, we're locked, and you guys want something to happen, which you have absolutely no control over. The situation is shitty, and as long as the sentiment is bearish, we're going to remain in the bottom 50% of that big range. And yes, that's the reality. And neither I or you have any control over that situation. I know you wish you could, but you can't. So there's only one reality with this thing, and it's everything we just talked about today. The reality is that we have far significant probabilities to go higher later in time, but it requires long stop losses and validation, no short-term gambles with tight stop loss and leverage. And if you figure it any different than that, then we're going to have a problem. There's no other way around that but to let it happen, and then we'll see what the market pulls out. But the statistical outcomes are far more profitable for the bulls if you are patient enough to trade the appropriate time frames. That being said, more than enough for today. Bye guys.